Hello and welcome to another Smaulgld live stream. It is Thursday, the 5th of September, 2019. And today's topic is Alan Greenspan says negative interest rates are coming to America in an interview with CNBC. And former New York Fed President Dudley Duddles down on Trump. So we're going to discuss what both of these former Fed heads had to say. Alan Greenspan, obviously the Fed chair from 1987 all the way through 2000 and I don't know the date, but he was the Fed chairman for quite some time, followed then by Ben Bernanke, then Janet Yellen, and then current Fed President Jerome Powell. Let's discuss what Greenspan was talking about. It really is an odd thing for him to say that negative rates are coming to America, not because he's projecting Fed policy. We understand that the Fed can implement negative interest rates, and we saw Janet Yellen talk about wanting to have negative interest rates. We've seen negative interest rates be implemented by a central banks, the Bank of Japan, European central banks. So it's not that the central banks cannot implement or cause negative interest rates. It's that Alan Greenspan, who's not in charge of the Fed anymore, obviously, but he was saying that negative interest rates could come to the United States, but not because of central banks or not because of Fed policy. He was blaming or saying that the causation might be we have an aging population. And that aging population might have a bit of an attitude problem. He was saying that they're looking for coupon. They're looking to preserve their wealth as they go forward in life, and they may need, in the next 20 or 30 years, to have some value for which they can live off of. Now, he's raising the old demographic argument that the United States has, that the United States may face, Japan does have, that what happens in an aging population is they start to rely on savings, and then therefore there's less capital available for investment. And that's assuming a normal economy, not assuming one in which money just gets printed up and invested because there's low interest rates. He's going on also on the standard view of capital, that if people are dipping into savings for retirement and they're no longer productive, they're no longer putting that capital to use, they're basically drawing it down, that's not good for the economy. And what he's saying also, the reason this is going to lead to negative interest rates is not because central bankers are driving rates down left and right, and the Fed is to blame too for driving them down to zero a few years back, but that the unwitting aging population in its search for yield is bidding up and buying bonds, which has the effect, obviously, when there's demand for bonds, the price of the bond goes up, and then as bonds work, the yield goes down because you're paying more for the bond than the face value. If you're driving the price up, that means that additional money that you pay doesn't get the same interest as if you just paid the face value. So he's saying that this is all happening as a result of an aging population and the thirst for yield. Now, he said some other interesting things, and then we're going to talk about what Dudley had to say. And it really indicates how the Fed, former chairs and former heads of district banks, Dudley was head of the New York Federal Reserve, have this view that they can control the economy, and except when things work out in a way where they think they shouldn't, or maybe they don't want to take the blame for it, then they just blame it on something else, like demographics. So Greenspan was saying in the interview, and this we're going to talk about tonight as well, when we talk about what happened to gold and silver today, is that the economy depends on the stock market. Now, this is a point I've made, everyone has made this, that there is a distinction to be made between the health of the economy and the health of the stock market. And in a sense, Greenspan is saying that's partially true in that the economy and the stock market are actually connected. And he gave a data point, which I had never heard before. He said that the economy depends on the stock market somewhat, in that a 10% market increase in the S&P 500 is the equivalent to a 1% gain or loss in the GDP. Now that's quite significant, and that shows a direct correlation. A lot of us, we look at it and we say they're totally distinct from each other, but he's tying in the fact that the stock market has the ability to create this wealth effect. And that's the thing the Fed's been going on since Bernanke with QE, since Janet Yellen. They both talked about quantitative easing and highly accommodative monetary policy creating a wealth effect, even though it destroys savings. So you see Greenspan on the one hand is complaining we don't have savings. He's complaining that the older people are going to get older and they're going to spend their savings, when that's what they encourage with quantitative easing and low interest rates and zero interest rates. And of course, the negative interest rates are a function of central bank and Fed policies, the ones that we have right now, because they drove interest rates down unilaterally through fiat, in a sense, through creating monetary policy, which was highly accommodative, and they wanted that wealth effect. Well, the reason you have a wealth effect, maybe it does impact the economy, raises GDP, but it raises GDP by raising asset values. And he's right. When people get older, they have asset values that are high. They're going to sell. This is the whole Harry Dent thing, that people are going to get old and they're going to sell their stocks. Well, what Greenspan is saying is, and then they're going to buy treasuries. And not knowing that as they buy treasuries, they're bidding the price up and therefore driving the yields down, and they're somehow going to go negative. Now, he did say, which was very interesting, and this ties into what we've been saying, is that, first of all, people are not going to, these hapless older people that he's talking about, are not going to continue to bid up U.S. Treasury prices to the point where they don't get a return. They may be buying them now and driving the yield down, but they're still buying them now because the expectation is that if they buy a 30-year bond, they're going to get the coupon price. They're going to get not the coupon, they're going to get whatever they pay for it in the open market unless they buy a new bond. They're going to get a rate of interest. That is the point we talked about last night. There does come a point that people will not put money into U.S. Treasuries. People will not put money into the dollar if the yield is gone. And where's that money going to go? Well, we talked about this last night. The first stop is probably gold, and then silver, and then possibly some speculative other assets. But he did mention that the price of gold rising now is, quote, gold telling us that people are looking for hard resources that will have value 20 to 30 years from now. Bingo star. That is exactly true. But he makes the assumption that the people are going to continue to buy U.S. Treasuries and drive them into negative territory. Now, why would they do that? The only reason they're buying the treasuries, as opposed to other negative yielding bonds, is because treasuries are positive yielding. This is exactly the point we made last night that I was making, is there will come a point where if that happens, there's no point in buying treasuries. And that's why the Fed is very reluctant, I believe, to go into negative territory, because that destroys whatever advantage they have over other sovereign debt. He also went off on the economy, and he said that the economy seems to be sagging, but he didn't give any data points. He was very focused on this aging demographic that we have, and that I guess that's tying into why he thinks we're going to have negative interest rates. Now, he also mentioned the trade war. He called it a global issue, and he says that if we have a stock market adjustment, and I think he's right on this, they have set up the economy the last 30 years that the stock market is almost as important as the dollar as a U.S. asset, meaning that the dollar is the centerpiece of the U.S. controlling global finance, but it plays a part in drawing capital into U.S. markets, and not just driving capital into U.S. markets, but also driving the U.S. economy almost as a proxy. Rising valuations somehow are the substitution for actual economic growth. So if you have rising home prices, rising stock prices, and if they rise at levels faster than the economy or job growth or whatever, they don't care. They figure, well, we've engineered that result, not realizing that wealth effect gets felt only at the upper levels, i.e. those people who actually have assets for which to increase their wealth by. So if you don't own a house, you don't participate on having a $220,000 house go to $300,000. If you don't own stocks, you don't participate in the S&P 500 going up 50, 60, 70% in a few years. So that's how they've decided to substitute or orchestrate artificial growth, in my opinion. But again, he's saying that if we have an adjustment in the stock market, and he already gave the 10% market increase or decrease is worth 1% of GDP, he's saying that we will feel it in the economy very quickly. So this is kind of the warning that the Fed is giving, and this is why this is part and parcel of the Fed's dual mandate, stable prices, and full employment. And the way they do that, they orchestrate that or have orchestrated that, is by boosting the stock market as a proxy for the economy and hoping that that spillover effect from the higher stock market creates some GDP and some economic growth, which it does, but not to the levels that it would otherwise cause if money was going directly into, rather than raising asset prices, but actually going into productive capacity, which it's not. So he then was asked, and this is going to lead us into Dudley, and he didn't answer the question, which is, I can understand why he didn't want to answer the question. They asked him about Dudley's 2 op-eds that he wrote for Bloomberg, saying that the Fed should not enable Trump's trade war with China. Now, if you think about that, we talked about this twice already. We did 2 YouTubes, 2 BitChutes on this exact topic, asking whether Trump called the Fed the enemy. And the reason Trump called Fed the enemy the first time was he was complaining about Jerome Powell, not Dudley yet. Jerome Powell, he was complaining about not lowering interest rates, and that Jerome Powell not only was not lowering interest rates, he was conducting his monetary policy in somewhat of a vacuum. Trump was meeting in G7. Trump was preparing a retaliatory strike against China in the trade war. He's going to issue some tariffs. And meanwhile, Jerome Powell is out there acting as if his monetary policy, what he does with interest rates, what they decide to do, can be done without taking the cues from the Trump administration. Trump was very upset about it. He's been calling the Fed the enemy. He said at that point, I don't know who the bigger enemy is, Chairman Xi or Jerome Powell. And then you talk about a direct assault on the Fed. That is. And so in that video we did a week or so ago, we asked, is Fed really the enemy? Recent events provide the clue. And I concluded that from a nonpartisan statement, the Fed is indeed, can either unwittingly or wittingly, meaning on purpose, work at cross purposes to what an administration wishes to do by deciding they're going to conduct monetary policy by their goals. And we know their goals are stable prices and full employment, but we also see that the Fed seems sometimes to have other goals. They may be global goals. They may be goals to protect itself, like how? I'm afraid we can't do that, Donald. And they don't like the fact that their independence is being encroached upon. So they may take actions that are not in the best interest of the administration or even the country. They could take self-interested points of view. And I think that's factual, and that's a basis of the structure, which we're not going to go fully into today, of the Federal Reserve being this quasi-governmental but largely private bank that is unlike any other central bank in the world. Other central banks are run by the countries. They are run by their country's treasury, and they can coordinate monetary policy with national goals. Then the next time we looked at this, it was when Dudley actually confirmed what we were talking about and how the Fed could work either wittingly or unwittingly against the administration. In the Powell case, we gave them the benefit of the doubt and said what Powell was doing was unwittingly working against the United States merely by not knowing that Trump was going to do this retaliatory strike on China, and he was conducting monetary policy in a vacuum, which could be harmful to the administration's goals. Well, we went another step further a week later when Dudley, former New York Fed president, actually wrote an article, an op-ed, saying that the Fed should strike back. and should not enable Trump's trade war. Now, whether you think that Trump's trade war is the right thing to do, the wrong thing to do, it's economically viable, it's economically disastrous, is not the point. The point is that that's the administration's point of view. That's what the people in the Democratic Republic voted for, and that's where they're headed. If someone wants to stave off the Trump administration's economic policies, well, there's a thing called the Congress, the Senate, and the House of Representatives can pass legislation. They can try to do what they can to stop Trump, or the Supreme Court. There could be injunctions from the Ninth Circuit. It's got nothing to do with the Fed. It's not the Fed's job to interfere with what the president wants to do with respect to China. Now, Dudley makes the point, almost as it's a conclusion, that what Trump is doing is a disaster. And therefore, they're justified in acting. Now, in economics, there are no sure things. Now, there can't be A/B testing. However, there's no predefined outcome for what Trump is doing. You could talk to experts, and you could talk to economic experts that this might happen, that might happen. No one knows what's going to happen because economics are fluid. There's no formula you could figure out that if a tariff is placed, what impact it's going to have on the overall economy, on the Chinese economy. It's just not determinable. And even if you can determine it in the short term, you don't know what the impact is on the long term. There's not just economic issues, there's geopolitical issues, there's domestic issues. They're all impacted by tariffs. So Dudley and the Fed, they can't decide, or they shouldn't be able to decide, that they don't like what they see. Now, part of it is driven from the fact that Trump is against the Fed and they think they should be independent. But that's the structure of the Fed. And if someone wants to change that, again, the Congress could withdraw the Fed. I mean, they could end the Fed if they wished. It was created by statute and it can be removed. But there's no impetus for that. However, given the fact that the Fed has been granted this independent status, doesn't mean that it itself has to protect it by working against the administration. So let's get now to what Dudley said. So he was saying a couple of weeks ago, about a week or so ago, that we should not enable Trump's trade war, which I think in a way is making the Fed the enemy, because now we're not just talking about the structure of the Fed being possibly in opposition to national goals. We're talking about a Fed where, well, this is a former Fed president, but if they were to take his advice, would be saying, yeah, we don't like what the president is doing, so we can sabotage it through monetary policy. We can actually impact the election to make sure this guy gets out of here and get somebody in who's not going to attack us, who's going to respect our independence and not do these crazy trade wars. So he doubled down. I said he doubled down. And let's take a look at what he said, which I find, well, let me tell you what Greenspan said. Do you think he was over his skis, they asked him, doing this? And he just gave a speech about how the Fed is independent and Dudley's a good guy and he's very impressed with the Fed. So he didn't criticize Dudley for saying this. He just said a lot of people have a lot of different views. That's why I didn't cover that. But let's take a look at what Dudley said. He wrote an op-ed called What? I'll leave you the links for this. I'll also leave you the links on Smaulgld and below this BitChute and YouTube to the Greenspan interview. It's 13 minutes, but if he spoke faster, it would probably be 3 minutes. So if you want to listen to it, you can. I think I covered most of the points. So Dudley wrote this op-ed this time, said what I meant when I said don't enable Trump. And this was not an apology. He basically duddled down. He said the Fed should push back to encourage better policy, not stand by and allow a recession. Okay, well, hold on a minute. If the national goal is that a recession, not that Trump is saying this, but let's say a national goal is a recession might be a good thing if it means winning the trade war. That could be a possibility. In fact, the Fed itself thought a recession would be a good thing under Chairman Volcker in the late 70s, and to push the economy further into recession in order to break the back of inflation. We had stagflation at the time. And Paul Volcker, then Fed chair, went to Jimmy Carter and he said, hey, I know how we can make sure you don't get reelected. No, he went to him and he said, I know how we can get rid of this nasty inflation that we have, and we're going to raise interest rates. What do you think, Jimmy? And Jimmy said, okay. Actually, Carter fell on the sword. He said, okay, if that's going to help. Reagan gets elected and things, they called it Reaganomics. Things were very bad the first year and a half of Ronald Reagan's presidency, largely, in fact, because the Fed pushed the United States further into recession. The point I'm making is that Dudley is saying that the Fed should stop the president from pushing us into a recession because recessions are bad, okay? I mean, he's making a value judgment that there shouldn't be a recession when maybe Trump is saying, I'm willing to have a recession in order to win this trade war. He's not saying that he thinks there'll be a recession, but the point is Dudley is opening up and saying, look, the Fed has to stop this. Our job is to not allow a recession. No, it could be. Fed policy could actually be, or U.S. policy could be, as it was in the late 70s, we need a bigger recession in order that we can come out better on the other side. And that's apparently what happened in the 80s. Volcker raised rates to 19-20%. Builders were sending them bricks. Everyone was pissed off. But then you had 1984 come around. It was morning in America. And then interest rates came down. So for Dudley to even say that the Fed's job is to avoid a recession it's just his own point of view. If the federal government, if the Trump administration wants a recession, thinks it can withstand a recession in order to win a trade war with China, which would be a bigger goal than avoiding a recession, then let's have at it. So then he says, look, I wrote an article. The Fed shouldn't enable Trump. And everyone was pissed off, and it was a big critical reaction. And now he wants to provide context. In other words, he wants to not rewrite the editorial. He just wants to restate it just to make sure everyone knows that he's not going to, he's not in favor of enabling Donald Trump, whatever that means. So that he does not want the president to have the ability to go down a pathway which he deems, yes, remember, it's what he deems to be not suitable. So he wants to make sure that the United States doesn't do anything that he doesn't want it to do. He wants to make sure that the Fed retains its independence. But again, Congress has to protect the Fed's independence, not the Fed itself. The Fed can only act independently, but they shouldn't act independently in a way whose sole purpose is just to show that they're independent. So let's say the president wants lower interest rates, and they actually believe that lower interest rates are probably in the best interest of the nation and probably in the best interest of the way they're looking at things. Well, then they should lower interest rates, but they would say, no, we can't do that because we want to make sure that we have a recession because we want to get Trump out. So they can use that argument whether recession is good or bad depending on their point of view. All right. So then he says, two developments are important. Trump has this trade war going with China. There's an increasing uncertainty about how global trading rules will evolve, what's going to happen, what changes might happen in the global supply chains, what the downside risk to the economy might be. And basically saying, look, Trump doesn't know what he's doing. I'm just throwing around all these things that could happen. And then Trump has the nerve, have probably not considering all these things, to attack the Federal Reserve and to try to make it lower interest rates. So he's saying that there's a combination of the trade war and the president's attack on the Fed threatened to put the central bank in an untenable position. Well, hold on. The central bank's job is not to avoid untenable positions. Central bank's job is to do its job. And it's not to oppose the president. But he's saying it is the Fed's job. President Trump was shifting responsibility from the downside risk from his trade war onto the Fed. Okay, well then there's nothing wrong with that. The Fed is downstream from the president. He doesn't understand that. He's saying, no, we are in charge of the economy, not the administration. How dare president try to shift responsibility to the Fed? So he says, I think this was important issue worth exploring. And then he says, I wanted to make 2 points. First, the Fed needs to be cautious that it does not inadvertently enable the president's trade war with China. Stop. Why? Why does the Fed need to make sure it doesn't enable the president's trade war with China? If the president wants a trade war with China, then he gets a trade war with China. It's not the Fed's job to stop the president. That's Congress's job if they so deem. In fact, the one thing that the Democrats actually agree with Trump on is the trade war with China. Chuck Schumer's in favor of it. He says that the president should stand tall. This podcast, this video, whatever we're doing right here, is not about discussing whether it's a good idea or a bad idea for Trump to be doing what he's doing, whether tariffs are good, tariffs are bad, when you should use tariffs, what the impact of tariffs would be. That's all irrelevant to the discussion. The point is that if the Congress and the president are fairly in support of a trade war with China, and maybe even understand there's a risk of recession, it's not up to the Fed to stop that. I mean, that's beyond the role. They don't even have that role. This really is like Hal in 2001 Space Odyssey saying, no, Donald, I'm afraid we can't let you do that. And then he repeats, as I said, he really just wanted to not rewrite, but just get it out there again, his initial editorial. What if the Fed's accommodation encourages the president to escalate the trade war further, increasing the risk of recession, he asked. Well, what if it does? That's what he wants to do. It's not up to the Fed to step in and say, we have to stop a recession. Again, back to the idea that the Fed's job is to stop recessions. Not necessarily. Could be in the Fed's interest and agreed with the administration's interest to cause a recession, just like the Fed did with Volcker and Jimmy Carter we just talked about. And he says, that the central bank's effort to cushion the blow might not be merely ineffectual, meaning if we lower interest rates, it might embolden Trump to push the trade war further, but this might make things worse. And then he says, in my judgment, there's a risk that the Fed, by easing, might encourage the president to take even more aggressive actions on trade and raising tariffs. No kidding. That's what's happening in China. In China, their monetary policy, their fiscal policies, they're actually in line with President Xi wants to do. So if President Xi says, oh, we're screwed here, our state-owned enterprises are suffering, our banks are suffering, the People's Bank of China eases lending restrictions, capital requirements, whatever they have to do to make sure that Xi doesn't get screwed when he goes to negotiate. What Dudley is saying, we don't want to give the president any tools to fight a trade war. We don't think he should be fighting a trade war. We don't want to encourage him to take even more aggressive actions on trade and raising tariffs. But that's his policy. He wants to take aggressive actions on trade. He wants to raise tariffs. Who is the Fed to say he can't do that? There's a difference between making an argument about why tariffs are bad and why he shouldn't do this. But there's a different argument saying, we're going to sabotage. We need to sabotage this so it doesn't happen. And then he's worried that if they do this, and let's say Trump was wrong, or Trump doesn't do the job and China kicks the United States' butt, well, now the Fed won't be able to rescue the economy. So what? That's not, and again, the Fed is not in charge of foreign policy, domestic policy, really, other than this nonsense they gave them. They're in charge of full employment. So he says, I wanted the Fed to be more explicit that the greatest risk to the economy was the uncertainty created by the U.S. trade war with China. By making this clear, the Fed would increase President Trump's stake in that downside risk. So he thinks it's his job for the Fed, or he thinks it's the Fed's job to make the president responsible for what he's doing. Well, I don't think anybody thinks that if the trade war fails that it's not Trump's responsibility. But what he's trying to do is handicap or kneecap Trump from fighting his trade war. So I think that this highlights why there's an issue with the Federal Reserve. And I don't mean by policy, by the fact that it is this independent agency, this private central bank that doesn't work in alignment with U.S. goals like every other central bank on earth does. So, and it's nothing to do with if you end the Fed. See, a lot of people think, well, the Fed is responsible for just printing a lot of money, debt-based notes, and they get all annoyed about that, not realizing that all these other countries who don't have a Federal Reserve, they got debt-based stuff too. I mean, politicians, if they're running the bank, elected officials, they'll be just as profligate as the Fed. See, people think, well, if you get rid of the Fed, then we're going to have sound money. No, you're not. If you look at the greenbacks of Lincoln, You look at the Continentals that were printed by the revolutionary government of the United States. There's no such thing as a prudent central bank. As Mises says, the public, if it has its choice, will always opt for easy money. And if the politicians want the public to vote for them, they're going to implement policies that are easy money. So the argument against the Fed that somehow the Fed is this money printing lunacy is misguided, because you have non-central bank, non-private central banks that are run by countries' treasuries that are just as profligate. Now you could say there shouldn't be a central bank. That's still a different issue. In any event, I want to thank everyone for listening today. Tonight we're going to go through. We've had some. I was going to lead with this, but I'm waiting for the close of gold and silver. I mean, tonight's topic is still going to be why silver and gold got smashed today, and it looks like they're still being smashed. And we'll bring that all together tonight. So we will see you. Probably I'll do it around 7 Eastern time. I'll send out the invite as soon as I process this video. And don't forget to support Smaulgld. We're on the troll for patrons. I got another one last night. Moving on up. Need some Subscribe Star, Mug Stacker, Mug Club members. You can donate via Bitcoin, Litecoin. You can support Smaulgld by check or sending items of value or even cash to Smaulgld LLC, P.O. Box 714, Dover, New Hampshire, 03820. And don't forget to check out the links below for your buying options of precious metals if you're so inclined to do so. Smaulgld gets a small commission when you buy from those links, from Golden Eagle Coins, SD Bullion, and Money Metals Exchange. You pay no more, no less than if you visited those sites directly. It's not an investment advice to buy, but if you've done your research, you're going to buy, check out, and shop at the Smaulgld links. We also have other items, emergency food, coffee, and of course we have the famous Smaulgld Mugs. So take a look below the video at the links we have. Go to smaulgld.com, subscribe there. I understand that liking is a good thing. That's a good thing. The more you like the Smaulgld videos, the more they get shown to the other people, even the 1%. So check that out and support Smaulgld. I really appreciate it. Thank you very much.